Hello and welcome to the Global View on this Tuesday. I'm Andrew Gayden. Thanks for joining us again here at AusBiz after a 4-day Easter long weekend. Let's get to what happened on global markets overnight. They have begun the week modestly higher, while oil prices have risen as the US and Iran exchange verbal attacks, while President Trump reiterated threats to strike Iran unless it makes a deal by Wednesday morning our time. So US stocks advanced as investors looked for signs of progress towards a deal, with all three major indices advancing. The S&P 500 and Nasdaq notching up the fourth consecutive session of gains. Travel and leisure stocks, the outperformers there, along with aerospace and defence stocks. So there you can see on the screen shares of the chip firms. They were initially rose, then finished mixed on data showing global semiconductor sales rose 62% to close to $89 billion in February this year compared with the year earlier. Tesla shares fell as JP Morgan lowered EPS estimates following first quarter deliveries. Its shares down more than 20% year to date. Shares of Soleno Therapeutics surging after Neurocrine Biosciences agreed to acquire the rare disease drug maker. And Bitcoin's strength helped US listed shares of cryptocurrency linked firms such as Coinbase and Strategy advance. Well, Iran says it wants a lasting end to the war with the US and Israel and has pushed back against pressure to reopen the Strait of Hormuz. President Trump has warned that Iran could be taken out if it did not meet his Tuesday night deadline to reach a deal. He's threatened to destroy Iranian power plants and bridges, dismissing concerns that such actions would be a war crime. Meanwhile, US services sector growth slowed in March, while prices paid by businesses for inputs climbed to a near 3.5-year high, in a sign that the war with Iran is boosting inflation pressures. On Friday, the non-farm payrolls report showed US job growth rebounded more than expected in March, the biggest increase in 15 months, and also the largest since President Trump returned to the White House, while the unemployment rate fell to 4.3%. US Treasuries were little changed as bond investors were caught between optimism over reports of a ceasefire and unease over President Trump's threat to escalate the war. The yield on the US 10-year was at 4.33%, the 2-year at 3.85. Australian 3-year government bond yields closed on Thursday prior to the Easter break at 4.73%. The 10-year was at 5.06. The US dollar index down slightly on the day, the Aussie trading at 69.2 US cents. Oil prices climbed in choppy trade overnight as the US and Iran engaged in indirect talks that could lead to de-escalation of hostilities. Brent crude futures were at close to $110 a barrel. Gold edged lower as investors await further signs from the Middle East. Spot gold at around $4,650 an ounce. Copper rose 0.5%. Iron ore up to $111 a ton. And Bitcoin is currently trading just shy of $69,000. So let's get across those market moves. Steve Sosnick, Chief Market Strategist at Interactive Brokers. Steve, welcome back. Good to catch up with you. So we saw some extraordinary rhetoric coming from the US president over the weekend. How did the market interpret that? Obviously, he is threatening to strike civilian infrastructure in Iran. Is the market interpreting this as a further bluff, if you like?
Good morning, Andrew, and I hope you and all the viewers had a great long weekend and a great Easter holiday. The market, I don't know that it really knows what it wants to do with this stuff. I think it wants to take him at face value. First of all, there's an interesting little pattern that there's a lot of bluster over the weekend, and then sometimes Sunday night, Monday morning, some statements come out that are a little less blustery, for lack of a better word. And I think that the talk of a 45-day ceasefire came out conveniently when futures were lower overnight our time. There've been a lot of Monday mornings where there's been some sort of positive news. I think the market's come to expect it. Today was also because most of the world was on holiday today. It was actually I think it was the lightest volume day we've seen all year. And so there wasn't much conviction either way. There was the press conference that he had this afternoon. It was not easy to parse, let's put it that way. But again, I think that it's just a very difficult to read scenario. But right now, US investors remain more fearful of missing a rally than they are of an actual decline. So I think you have to take it in those terms. We'll see what happens if and when the bombs start flying around this time tomorrow, I guess. But
Yeah.
there's a lot.
So, I mean, are they betting on that taco trade then?
Oh, absolutely. Whether you want to call it the taco trade, whether you want to call it the Trump put, that's absolutely what it is. Is there's this belief that the markets will, well, the whole situation will get better because Trump will change his policy in response to declining markets. I don't know that that trade has much more to run, barring any um, actual positive developments. We still have not gotten back to the 200-day moving average. There's an old saying, nothing good happens when you're underneath the 200-day moving average. And that's for the S&P, I should mention. Um, if we get a positive development, of course we can go higher. But I think right now, again, the markets are very disposed to looking on the bright side of things. And one of the ways we see this is when I look at the skews on index options, SPX, NDX, et cetera, there's a strong implied volatility bias to the upside. The skew curve, which is normally very asymmetrical, is actually relatively symmetrical now. And the reason for that is no one wants to miss this rally. I'm not sure if it's FOMO insurance or just outright speculation or some of each. But that is a very strong underlying theme in US stocks right now.
Yet, Steve, I mean, we've already seen that damage done to the global economy. Even if the war were to end tomorrow, we know what's going on in the oil market at the moment, given the damage that has been inflicted on oil infrastructure, which is going to take, even by conservative estimates, months to restore. So, what impact overall does that have on growth, and in particular, earnings growth going forward?
Well, you just hit upon it. It's a pig in a python problem. Even if everything were to magically get fixed, overnight, it still takes a long time for tankers to get from point A to point B. It takes time to refine the oil, and it will have problems on global growth. And yet, it also has a negative impact on pricing. I wrote a piece last week called "Dude, Where's My Rate Cuts?" You can get it at interactivebrokers.com. And basically, most of the major central banks in the world, markets have moved their expectations on rates about 50 to 75 basis points higher. Australia not so much because the RBA was relatively quick about raising rates. Japan not so much because Japan is in a sort of in a situation of its own. But there is certainly this stagflation concern out there. At the last Fed press conference, Powell dismissed the notion of 70s style stagflation. I don't really disagree with him on that one. I don't think we get that, but you can certainly come up with a scenario where global growth is impeded at the same time that there are major price pressures. That's a very difficult combination for central banks, whether you want to call it stagflation light, or come up with a new term altogether. It's a difficult situation.
So, in terms of investor strategy, then, Steve, you're talking about the market, really expectations. They don't want to miss a relief rally as such. Then, do you buy now? Do you hold off? Do you have elevated levels of cash?
I think it's never wrong to hold on to some cash here. It's a very uncertain situation, and to me, as we're discussing, this is not something that lends itself to an easy, quick fix. I think certainly you don't necessarily want to run for the hills. I'm going to, one of the things I've been reminding people, which I think is always a sensible idea, is reassess what your stomach tells you after a move like this. If the events of March, got you a little upset stomach, then you're carrying too much risk. Lighten up, move to cash, move to short-term fixed income, move to lower beta stocks. If you took these moves in relative stride, stay the course, and that means you're okay with it. I'm not particularly optimistic about the outcome here. I think U.S. stock markets particularly have gotten a bit ahead of themselves. There was a nice inverse correlation between oil and stocks. That seems to be broken, which is telling me that I think I hope we're just sort of rebounding from an oversold condition and not engaging in some magical thinking here.
Well, I know hope's not a strategy, but we do hold out hope. Obviously, this can be resolved sooner rather than later. Steve, terrific to catch up as we always do on a Tuesday our time. Thanks for joining us from Interactive Brokers.
My pleasure, Andrew. We'll talk soon. Take care.
So let's return to the local market then. 4 days off. Hopefully you've been re-energised as such. Look, we are expecting to start in the green, but it's pretty marginal, as you can see there, with S&P ASX futures up just 0.06%. So we'll get right across those market moves when we get underway in just a couple of minutes. Stay with us for the open.